folks, what we are about to take a look at is hands down, for as far as I can tell, has been the best performing Canadian REIT in all of the Great White North. And of course, we're talking about Granite Real Estate Investment Trust, which is currently trading up 20% year to date, even in the midst of this pandemic. And as I promised you guys, this week I have been highly focused on explosive stocks in different sectors of the market that are coming from your suggestions. So consider hitting the like, consider subscribing, because your suggestion may be coming up next. But nonetheless, let's jump on. Welcome back. Passive income investors alike to the good, the bad, and of course the ugly surrounding Granite Real Estate Investment Trust, hands down being one of the best performing REITs up here in the Great White North since this pandemic has taken place, trading up a whopping 19.6% year to date, and even over the long term performing just as well. So we're going to do a quick overview of their fundamentals, take a look at some of the properties, and then of course I'm going to share with you whether I'd be buying this or not. Now the dividend yield, not nearly as attractive, but there's some other reasons that I would be attracted to this 3.7% dividend yield that we will take a look at. But the first fundamental I always run to, is it trading on a discount against its current market cap, which trades at $4.45 billion. Now, how do I figure this out? I simply go into Yahoo Finance, I open up their balance sheet, and I scroll down to their total assets, which currently sit at $4.8 billion. I will then minus it out from the total liabilities, which is basically everything they owe, you know, the debt on the properties, the equipment, whatever they owe, minus that $1.6 billion out, and they have an underlying asset, if they had to liquidate everything today into cash, of about $3.2 billion. So it's not trading at the biggest discount in comparison to things like REITs, but even still, you're getting some stupid great performance, which leads to the understanding of why this is trading at a higher valuation here, folks. But just taking a look at the dividend to see how secure this is, their current annual dividend is about $2.89 per share. And just taking a look at their adjusted funds from operation, I know this is boring, we're gonna get through this, just bear with me here, guys, because this is the juicy stuff that matters. But taking a look for the 9-month end, guys, here from their last earnings, they've received about $2.87. So just in the first 9 months, they have pretty much paid their entire dividend with one full quarter. Keep building up those revenues, guys. They have a payout ratio probably somewhere around 80%, I'm gonna say, which is fairly high, but we're talking about REITs. This is what you want in a REIT. And in fact, speaking of this dividend, and another reason it's fairly attractive, they have increased this thing every year, or basically every time their fundamentals have gone up pretty drastically, in which, announcing their third quarter earnings, they increased the dividend by 3.4%. And just taking a look, something that'll blow your mind, guys, look at the quarter over quarter growth here. And considering in Q4 of 2019 they did 73 million in revenue, skip to Q3 of 2020 when they did 87 million, and just scale this out over their annual income, it is in a very high growth trajectory, which is almost comparable to some kind of a growth stock, because most REITs do not grow at this pace here. So that is something that we love to see. Now let's take a moment and just kind of go over their properties, what they're doing here, how the heck they're generating this kind of income. And Granite is primarily driven by logistics and fulfillment centers, with a lot of big companies that we're going to see once we get into their investor presentation. But just taking a look, the thing that blows my mind the most is their crazy amount of diversification. Now, I don't know how they have this much of an outreach into things like England, Germany, Poland, Czech Republic, Austria, Netherlands, a lot in the US, and of course Canada here. Just taking a look, Canada and the US right now make up for $3.5 billion of their total property value, with Europe only making up about $1.7 billion. Now, they're obviously more highly exposed to Canada and the US, which again is something that would make me feel a little bit more secure buying this, because I can understand how this stuff works here, not really too sure how it all works in Europe. But getting the total diversification is something that we love seeing in companies, but this is also going to be a big hindrance to you, and I'm going to explain to you why this is at the end of this video. Now, just taking a look at their tenant bases, this is where things get really, really interesting. Now, when we're comparing it to things like RioCan or Smart Centers, this one falls into a bit of a riskier route, because those companies usually don't allow any single tenant to make up more than 5% of their total income, whereas we can see here Magna makes up for a total of 37% of their annualized revenues. But this company, you know, filling out those logistics and fulfillment centers for things like Amazon, RH, Hannon Systems, Ingram, I don't even know half of these companies, but I can only presume they're conglomerates, probably some of these coming out of Europe. But again, you are making a big bet with this company on Magna making up more than 1/3 of their total annualized revenues. So we're going to want to keep an eye on Magna if you are buying this stock, in which Magna's performed pretty well through all of this, which is a huge conglomerate that deals with everything from car parts for all of the different manufacturers. I think they even make car parts and things for Tesla right now. So Magna, a very pristine company, and I honestly wouldn't make it as the biggest concern, but I'm hoping they're going to continue to diversify away from this company. It'd be nice to see to get that around 25% at the highest. But again, overall, not quite complaining here, guys. And here we go in their investor presentation. Just to take a quick look at some of the stuff that matters that I had a little trouble finding earlier. The first thing is distribution from the FFO, the dividend, guys. I was way off. I thought it was 80%, but apparently it's 72.7%. The total debt to capital. So you know when we minus those assets from those liabilities, right now is only 27.4%. Probably one of the most under-leveraged REITs in here up in Canada as well. But putting all of that aside, guys, would I be buying this? I don't have much negative to say about it, but when I'm looking at REITs, I'm typically looking for income today. And the only thing that bothers me most about this, and things that people will overlook if you're on the Canadian side of the border, heck, even if you're in the US, guys, you are exposed to foreign dividend taxes. And even though this company trades on the TSC up here in Canada, unfortunately, the Canadian government states that if you are buying a company that doesn't have 50% of its operation revenue coming from Canada, that you are going to be paying foreign income tax. You're not going to be getting any Canadian tax benefits on those dividends. And just reading this little article that says foreign dividends and taxes. For Canadian tax purposes, foreign dividends are taxed like interest income. That is, they're fully taxable. Unlike eligible Canadian dividends, which would be something like a RioCan, there is neither a gross up nor dividend tax credit. Also, foreign dividends are usually subjected to foreign tax, which is usually about 15%, which they state here, but that could also get disrupted because I don't know how those dividends work coming out of Europe. So that foreign withholding tax could be anywhere from 15 to 25%. Now, this is one thing that is stopping me from buying it right now, though I do think it is a buy. It just depends on your current circumstances surrounding your tax advantaged accounts. What do I mean by that? Well, if you hold a Canadian RRSP, you're basically going to get away without having to pay any withholding tax whatsoever. This is one of the primary reasons I bought things like J&J and Pepsi in my RRSP, because why I don't advise you own things like Pepsi in a regular brokerage account, because not only are you paying the 15% withholding tax, you're screwed on regular income tax, guys. So you're basically going to lose 30% of that dividend. And presuming that you're getting a 3.77% yield in just a regular brokerage account, let's just knock 15% off the top plus whatever your regular income tax rate is, because you're not going to get any dividend tax basically benefits here. So minus out 30%, guys, you're basically knocked down to about a 2.7% dividend yield. Not something that I enjoy seeing, particularly considering I want to be able to retire off these dividends sometime in the near future rather than when I'm actually 60 years old, being again a 28-year-old investor. This is an absolutely incredible REIT, but these are some of the finicky details that come into play depending on what you're buying it for. Now, if you're looking for REITs that are going to continue to grow, you're not overly concerned about the dividend, and you do plan on buying it in either like a tax advantaged account, I mean, this would be a great buy here, guys. I don't think you're going to do any wrong because you are getting some global diversification. You're getting a part of the REIT market that isn't getting destroyed in this pandemic, and heck, a lot of upside potential still from a lot of future projects that they are still working on. In fact, they just did a deal for like $168 million I saw when I was reading through their investor relation, which I will leave all of this in the description below. And this week, guys, I'm going to be focusing on slamming out a ton of videos reviewing some high-flying stocks. I know this wasn't one of the ones you guys suggested, but I am going to be getting into things like NEO, a ton of other companies, thanks to what you guys recommended. So again, stay cool, stay awesome, and I look forward to catching y'all tomorrow.